So, a very good evening and a very warm welcome to all the participants who are joining in today's session. My name is Tanya Gupta and I am a chartered accountant by profession. Namaste, Sach. Hope you all are safe and doing well during these tough times. Though COVID cases have gradually declined to a very low level and things have started to open up, but I would seriously recommend you, rather suggest you to take all due precautions, whatever necessary, be it putting up masks or frequently sanitizing your hands, because our health is in our own hands. So once again, on behalf of Optotax and Voice of CA, we welcome all the tax professionals once again on a series, 3-day series on startups, right? The potential growth for chartered accountants, empowering the startups, etc. So before giving this rise to our faculty for today, let's wait for 5 minutes so that people from across India could join in, and together on this platform we can head towards learning and growth in a united manner. So yes, we have got a lot of registrations this time, so it is our duty to wait for our friends and go further with learning. In the meantime, I still remember the word startup had gained momentum in last decade, I guess so. Like if I remember, 2016, in year 2016, on January 16th, Government of India launched the Startup India initiative, which has rolled out several programs with the objective of supporting entrepreneurs, building a robust startup ecosystem, and transforming India into a country of job providers, job creators, instead of job seekers. So if you remember, in last few days, Zomato launched its IPO in over a period of decade. Only in a time span of 10 years, Zomato have become unicorn, right? So how the valuation is done, what exactly is startup, and what are the compliances which one needs to follow, all of that will be taken care of in these 3-day series. So stay tuned, stay connected, keep using the chat box, because we don't want your questions to be unanswered at the end of the session, or rather I would say at the end of the conclusion of the series. You should be satisfied, you should go and learn. You should have a feeling that actually we have learned something unique from this series, and it's a value addition to your clients, and you can give value addition to you first, and then you can pass on the benefit to your clients as well. Now I would like to take a moment to introduce my friend CA Neha Agarwal. She's from Voice of CA, and Voice of CA is a non-profit organization which has been constantly working towards the empowerment of the profession since 2009. We welcome you, Neha.
Thank you so much for such a nice introduction, Tanya. And I'd just take 2 minutes of the platform to say that Voice of CA has been contributing to the profession since 2009 with its update mailers and webinars just like these on varied topics mostly related to taxation, but we have been, doing it on varied topics as per the members' interests. And I just wish you all the best to have a great 3-day series. Thank you.
Thank you, Neha. So our guest of honor today will be joining in sometime. So I would like to introduce and welcome our faculty for today, ca.anand Gawade ji. We welcome you, sir. It's an honor for us to be sharing this virtual stage with you. So in a very brief introduction, though he doesn't need any, But Anand sir is the member of ICAI and registered valuer IBBI. He is into practice since 2002, so almost 2 decades have been he have been serving through profession and advised many companies and startups for valuation of companies, acquisitions, intangible assets valuation, etc. Additionally, he is associated with many companies for financial and structuring advisory, IPO advisory, etc. Over to you, sir, for your deliberation. Sir, you're...
Yeah. Thank you, Danya, for a wonderful introduction. I'm audible, right? The screen is visible?
Yes.
So in today's session, we'll be covering, like not only valuation of startups, but what are the stages of startups, how you should, as a finance professional, how you should apply different approaches towards the valuation of startups, depending on the stages. What are the steps of valuation, and what is, what kind of due diligence we as a valuer we have to carry out while valuing the startup. This is a broad scope that I'll cover into this given my time frame. So basically now valuation is a very emerging practice area, although it is into existence for more than 2-3 decades now in India. But because of regulatory requirements, now it has got a very huge momentum, especially from last 3 years since the IBBI, it has become a regulatory authority for registered valuers under Companies Act. Earlier, this section was applicable, but every chartered accountant could do this. But now, registered valuer has to be a qualified and registered valuer with IBBI. Again, under Companies Act sweat equity shares, we require such reports, valuation reports. Income tax, a lot of litigations already started out. Income tax, there are investor side, there is investee side also. We need to carry out different valuations. Even if the startup is registered with DPIIT, it does not mean the investor is exempted from all this taxation. Still, there are certain compliances we as a finance professional have to carry out from valuation perspective. Again, FEMA, FDI, ODI, under FDI again, transfer of shares, issue of shares, lots and lots of scope is there. Multiple times, in fact, one single assignments require 3 different valuations. Like foreign investor investing into India, we require chartered accountant valuation. Since part of the investors are domestic, we require merchant banker valuations also in the same deal. And since both of them or any of them is a new investor, then again Companies Act also we require to carry out the valuation. Again in valuation also there are different valuation standards. Chartered accountants have to apply Chartered Accountant Institute ICAI's valuation standards, whereas under Companies Act it depends under which RVO you are registered. You have to apply those standards and do the compliance reporting that way. Now, apart from this, me as a valuation practitioner, I do first 4 regularly, but there are multiple assignments coming out on an advisory part, not only compliance part. This is very interesting because advisory is where you have to actually apply more thoughts and efforts. And we get lots of assignments into investee company. They are planning to fundraise, or they are planning to dilute some stake of promoters, or to exit from the business. What is my real valuation? What is my, how much money or how much value I should expect from the exit? Even investors are asking us, we want to exit, what should be the right, there are disputes among partners, disputes among investors, shareholders. We are appointed as arbitrators also for valuations. Funds requires continuous quarterly or 6 monthly, depending on the fund size. They require continuous valuation reportings for SEBI compliances. Again, promoters. So this area, not from only startups point of view, but overall as from the perspective of valuation practice as such, have gone to a very great extent on it. And there is a new institute coming out called as IIV, Indian Institute of Valuations. Now, this institute will be a master governing authority, which is under, this bill is under consideration with the parliament. So once if it is implemented, then now this entire valuation practice will be, will come under umbrella of IIB. So what IIB will do, IIB will act like an Institute of Chartered Accountants or Cost Accountants, which will monitor and lead this practice to a next level. So there will be separate COP, separate membership number, separate examinations, and it will be a separate profession altogether. So apart from being a chartered accountants or any other financial professionals among you guys, this area is one of the very lucrative area for practice now. And at the same time, this is not something you have to just use your Excel sheets. No, that those days are gone. Actually, if you look at the IBBI regulations also right now, everything is supposed to be peer review. Everything is supposed to be audited from third party, and you are answerable to everyone. Not only that, you are answerable to loss also. If it is because you have deliberately you have done some mistakes, or deliberately you are going hand in hand. So this not only lucrative area, but this has become a very responsible area now. So we as a valuers, 90% of the chartered accountants, especially early practice stage or mid-size, like somebody with 10 years or 20 years of practice, usually 90% cases we guys will get of startups only. But whatever reports I have seen from other valuers, I always seen most of the time DCF. But DCF, there are so many guidelines given, so many, there is standard on DCF, but none of them I have seen. I know more than 50% reports are faulty, 50% errors, no logics given in the assumptions, discount rates. No, this is become very subjective to the valuer, but this is not like that. I'll explain what are the issues in DCF in my next slides. So we'll come to the startup stages and valuation methods available. Basically, there are different stages. We categorize that into 6 stages. One is idea and concept, first 2. So we can call it as a pre-startup or conceptual stage. So basically, idea is discussed, presented, concept is properly documented, pilot is tested, and gap analysis of the targeted market is done at this stage. This is called the pre-startup stage. Second stage is when you are committed and validation is done. Validation in the sense you are now going to a next level. Next level in the sense this product is tested in the market. Now sales is happening. There is a repeat customer. Mouth publicity is happening. Branding is happening. Distribution network is going to get established at least 1 or 2 markets, depending on your product portfolio. For example, you can take example of Cars 20. Within 2 years or 3 years, you can look at the company. There was one showroom beside me in Pune, just beside my office. Very big, huge showroom. And always I could see 10 cars, 5 cars outside that thing for sale or purchase. Always. Within 2 years. One fine day they closed down the showroom and they shifted to a very odd size, small office setup. I said, what happened? They said, now we don't require our brand. Now we are established. We are going to the next level. We don't require money for our brand. People will come to us only now. So look at the confidence they have now. So you can even compare these all stages with the Zomato. Since now Zomato was just discussed, and this is a very hot topic among valuers now. There are multiple opinions on the valuation and everything. But in my personal opinion, if somebody is buying Zomato shares at 140, then it is worth 140. So this is how the fair market value is calculated. It is all demand and supply. If you want to be part of Zomato, because there is no alternative to Zomato at present in the market. Maybe if Swiggy or somebody comes into next stages in the IPO, price might correct to some extent. But at this stage, it's a monopolistic for Zomato as long as stock market is goes on. So if you look at Zomato from 4 years or 5 years perspective, previous 5 years, you will see the exact stages. Now Zomato, if you say it is at growth stage, it is also at growth stage and also at validation stage. What I am trying to say is Zomato is still a startup. It is not a conglomerate. It is not a big company so far. It is still a startup because they are still investing into multiple ideas and validations. Zomato, I was surprised to see Zomato is now also into grocery deliveries. I can order milk and they will deliver me in 15 minutes. Then why I'll go to Big Basket and buy? I can't. I don't need to. They have given me some package. I paid that for 1 year. There is no delivery charge for me. But that is not something Zomato was made to. It was created to do this grocery. It was for hotel or restaurants like that. But slowly they are evolving. And now since I'm habitual for Zomato, I'm going to order everything. I'm ordering vegetables. I'm ordering grocery. I'm booking, all this pizza and everything for my home. Everywhere now there is Zomato. I have not used Big Basket for almost 3 months now. So Zomato is not only, so there can be multiple levels of these stages for every company. You take example of Ola. I am not sure how many of you know Ola is going to be an electrical vehicle manufacturing two-wheeler company or something like that 3 years back. We just know it only by car or that thing. No, the car model is already now reached to a level where they are now stabilized. Only because of some disruptions of this COVID. Otherwise, they are into operating profit. But these guys are way forward of our thinking. They are 5 years, 10 years down the line, they are forward in thoughts. So not only now they are renting the cab, they are now manufacturing two-wheelers and they are also coming up with cars. So now what will happen with that concept? So their model of cab is already at scale level, but their two-wheeler is now at validation stage. No, I am not sure whether somebody has got that delivery or not of this two-wheeler, but it will kill the market. They have such a money power, scale of operations is so huge, their operating cost will. So can you imagine somebody is a newcomer, somebody is directly threatening to Honda, Hero Motors, Honda or Bajaj or TVS to So in this new era, every new entrant can establish itself into a established brand within very few months, few years also. They don't need to be for 10 years, 15 years or 20 years. This is the beauty of startups, stages. So continuous evaluation is one of the characteristics of the startups. They will incur lots of losses, but into evaluation. They know they are burning. They are not stupid to burn cash. They're investing. They call it as a value investment into product development or something like that. And now third stage will come in scaling and establishment, where like take example of Zomato. They started A, B, C series. Pre-series A stage is where you need money to go into multiple markets or branding like that. So product is established now. There is a customer demand, good market is also there. So pre-series A is only for creating next level. Once you reach to A, B, C, D level, you will reach to very huge money lined up you to spend. You can reach to multiple states or multiple product line distributors or maybe countries also. So these are different stages and different valuation methods or stages available for all these valuation of startups for the various companies. So basically, again, valuation approach. The concept stage is seed funding. Like there is normally there is hardly any revenue or absolutely zero revenue. Product is conceptualized, and you can call this a seed funding. Testing is done. Normally, it is investor bootstrap, means promoter funding only, or some accelerator or angel investor is there. Then this is the range of investment they get. Technically, in my opinion, there is no method required for valuation of bootstrap or very seed stage. Thumb rule is you can value somebody from 1 crore to 10 crore depending on the likeliness of success of that product and entrepreneur's background, who is the management team, who are the into management members. Now it also depends who are they, from where they are. So if somebody from a normal MBA college is the entrepreneur, you will get valuation of 1 or 2 crore. But somebody from IIM Ahmedabad, the same number becomes 20 times more. I don't know why, what is the approach towards that kind of valuation, but it is the ground reality. Again, some management team member with proper experience of the industry, again, the valuation may slightly go up. Again, Series A stage is like revenue traction is there, slightly momentum is there, acceptance is there. They have established the product. It needs some improvisation, and although, of course, the cash burn will be there. Now here, the early stage venture capitalist will come into picture. The normally investments is like 10-20 crore to 30-40 crores. This is just illustrative number, so it does not mean this is the exact number. For company like Ola will have more pre-series A, but company like some IT company or some other technology company will have lower depending on their requirements. And series A, B, C, etc. will have strong revenues, very high growth rate. Okay, because they already burn a lot of cash. They know how to grow very fast level. Here, private equity players, family houses, strategic companies, or large VC funds will come into picture. And normally investment starts at around 40-50 crores and onwards. The difference between pre-series A and B, C, D is basically the size of the ticket. In the sense, money, 20-30 crore or 50 crore or more. Otherwise, logically, everything remains same. How it is to be valuation. Most of the time, DCF is used, but DCF is a very two-sided sword. It is only Excel sheet model. If you change one number, it will change everything. So that is not valuation. If you look at the valuation standard properly, they have given very clear that if you want to apply DCF for a company without any track record, you have to use comparable transaction method as well to justify whether your DCF value is logical or not. It's a very clear word in the standard, but nobody read the standard. They just jump on the DCF. So when you are doing valuation of a very, let us assume a bootstrap startup, then how you will carry out that valuation? Only on Excel sheet. So let us say some Excel sheet is there. Within 2 years, you will, the promoter will say you will reach 100 crore revenue and 20 crore profit and all. Okay, fine to understand, but you will get a very fine valuation, 500 crore. But where is the due diligence towards that as a valuer? There is no due diligence. You are just relying on what they have provided to you. So I will cover how you have to carry out due diligence in valuing such kind of valuations, especially very early stage valuations. I will cover that slide. But at the same time, suppose there is a 50 crore valuation as per my Excel sheet. We need to identify as a valuer whether there are certain deals into similar segment, similar stage, at least from 30 to 60, 70 crore range, maybe 2, 3, 4 deals. So we can say, yes, companies with this kind of, business model or stage of business, they are getting some valuation of 20, 30, 40, 50 crore. Now, where you will get these deals? So there are certain portals available in India also, abroad also. You have to subscribe to them and obtain that deal database with you. Otherwise, DCF, as I said, it's very easy to use, apply, adjustments are quite possible. Everybody expects valuers to do adjustments. This is become like a more of a thumb rule that now I will get my valuation from any valuer, and this is my experience also. People are getting such kind of valuations without applying their own thoughts. But going forward, this is going to be challenged now. You are supposed to be answerable. You are supposed to, if there is a dispute, there is a fraud, you are supposed to go court and give your all documentation. I have seen multiple valuers giving backdated reports, but there are email communications on current dated. Nobody understands the intricacies and liabilities it may arise in future. When everything is good, everything is good. But if one investor make a complaint with say ED or something, then you are one of the person who has adjusted that deal. So avoid such things. Basically, this is what I'm trying to say. So apart from DCF and etc., DCF also I will cover again, but these are very different other methodologies. This scorecard methodology basically. So in scorecard, we analyze basically strength of the management team, size, opportunity, market size, product, etc., timelines, how it will, barriers, entry barriers, different. This is illustrative again. You can make a list of your own identifiable comparative factors and make your own analysis also. Now, usually this is the illustrative thing, like strength of entrepreneurs, you have to give either -3 to +3. So your range of 6, basically 7, -3 to 1 0 1 2 3. So you have to give some marks between these 7 numbers. So these 7 numbers, and you have to multiply that 7 number, one of the number of 7, against this range. So you will get some number as sum of this. So this range, for example, I have given some company, let us say Zomato only again, and I assume it is an early stage. First deal of the Zomato. So what will happen? I do not know promoters because they don't have experience, etc., etc. So, but I said, okay, fine. They are from a very, very good college, and they have some, let us say, hotel industry experience. So I gave +1 mark here. Okay, then size of the opportunity big, very big. I will give 3. Product 2, channels 1, stage 1, investment round 1, and like this. Now there will be some multiplication and you will get some sum of the above here. Now what you have to do is sum is multiply this sum, assume this sum is 50. Now you need to identify this sum with one of your similar deals done in the industry. Now again here you have to identify similar deals, means new entrant of aggregator, please don't compare with Swiggy's. You have to compare with Swiggy's or Zomato's early stage and identify, let us say some company got 50 crore valuation. Then you have to multiply that 50 crore valuation, assuming that they have got all the 100 marks. But in our test now, our promoter has got only, or our target company has got only 50 marks. So give 50% of this example or some identified company. This is one of the method. Now limitation of this method is it is very subjective. Very subjective. I can make 10, I can make 50. Very subjective method, but this is at least some method, it is widely used. But again, perception and understanding of value or discussions with the management team, everything matters in this case. Now you can, as a valuer, you may be very good into Excel sheets or presentations, something like that, but how you will give marking to the type of business or need for subsequent, you have to just fairly estimate that thing. But product, size of the opportunity, again estimation. So very subjective method. Then this is Barca's method. Now I have personally never used this method because this is totally subjective in my opinion. Again, similar to this chart, Barca's also have given one this chart. So what they have done is basically you have got a very good concept. Okay, fine. Give me details of all these 5 areas of that concept or some startup idea, quality management team, working prototype, board, and sales, products rollout or sales is happening or not happening, like that. So in this method, maximum valuation you can get is £2 million. Now, whether 2 million is a standard number, I do not know. So that is the reason I don't use it. For example, if ex-promoters of Flipkart comes and start their own some like grade, for example, and if you are started valuing grade with this method, it will fail. Without zero revenue, they are able to achieve like 500 million some valuations, but you can't apply this method with this standardized number. Okay, because this is again very subjective. So this you can use only when it's a very regular kind of startup, multiple like education startup, very flood of education startups we are getting, like IT startups. We are getting IT startups floods, lots of inquiries. Food technology, lots of inquiries. There you can apply this method. Again, as I said, you have to look at the management quality. Most important in all these things. If the quality is not good, they are not qualified. I am not saying qualified only do the business, no. But still from risk perspective, qualifications of management team matters. There is no issue. So don't ignore that quality of management. This is most important aspect in any valuation. Again, valuation approaches, market approach, everybody knows this normally, comparable transaction. You will get everything only from database. Just don't Google or just don't run here and there. You need some proper database. We use this venture intelligence. We use VC Edge. Multiple databases available in India and at a reasonable price actually. So these are market approach. So you have to compare certain characteristics, identify, comparable transactions, do qualitative similarities, identify capacity, product lines. I will give one simple example next slide, and do certain adjustments into valuations and carry out the valuation. Again, rule of thumb, like cement manufacturing companies or sugar companies normally are valued at certain capacity or established or sales capacity, metric ton capacity, like that. Income, very famous method, DCF. Normally DCF is applied and not income capitalization. Income capitalization is applied only when the business is matured and there will be a consistent, what we call as a terminal value in DCF is nothing but income capitalization method. But normally startups are not using that valuation model because they are not matured yet enough to use that method. Cost, again, rarely used for startups unless it has reached to a certain level, like replacement cost or reproduction cost. You have to identify how much time and efforts or cost they have incurred, what would be the current inflation rate and what would be the current price to replace that cost or reproduce that cost, what would be the depreciation. This is again a very statistical, you can say, or analytical work to carry out, identify each cost, manpower cost, product development cost, marketing cost, and apply all inflationary trends to those numbers and arrive at that price, value. So this is, but hardly anyone is using this, and this is normally used when market approach and income approach is not practical in certain cases. Only when these things are used. Summation method is like you have to identify each and every, because there may be multiple verticals or multiple divisions into a startup. Then you have to identify each separately and then carry out the valuation. Like Ola will have cab business and manufacturing of two-wheelers also now. So you have to identify each separately and carry out the valuation. This is one simple example, comparative chart. This was for some meat selling startup. Basically, they were into fish and some other frozen meat. So this was one of the, we identified the deals, different companies into same, these are the 6 companies they got funded. So we identified those. We identified their model. We understood through discussions, or even normally promoters also know my who are my good competitors and how they will carry out the processing, brand approach, inventory, delivery time. So these are multiple parameters you have to identify, where presence, and then do certain adjustments to each value to arrive at your own value. For example, you can say I am into 6 cities, so this is only one, this is only one, these are 4. I can use these simple 2 companies for valuation. But valuation of say Easy Meat, I will not use because it's only one single city, whereas our target client is into multiple cities. Now let us say fresh or frozen, or somebody is only seafood, but our customer maybe is not only in sea, it may be into some other products also, groceries also, or some other perishable items also. So we need to identify every parameter for comparison. It's very simple logic. Like if we have to value let us say a residential flat, how we will value? Same, locality, area, quality of the construction, age, road facing, not road facing, floor, which society, what is the famous, and we will also identify from database of this government registry to establish the rate for consideration. Identical logics are here, identical logics. So for example, if I'm in Bombay, so some flat in say sea facing flat in Bombay, I'll get let's say 50,000 rupees square foot, but I can't use same for on the same area but nearby flat, which is having only 4 flats building, and I'm into like 100 flat building. I will get a premium over that. So identify those
So,
things. Yeah.
sorry to break you, stop you in between. Actually, Avinash sir had joined.
Okay.
So we could continue if you don't have any issues.
No issues. Go on.
Let's stop your screen share. So could you please stop your sharing?
Ji, Tanya ji.
A very good evening, sir.
Good evening. Good evening. Are you able to hear me?
Yes, sir. We are able to perfectly hear you and see you. First of all, I would really like to thank you for sparing time for us and providing this opportunity to share the screen with you. So very warm welcome, although you doesn't need any introduction, but it's my duty to introduce to all my participants your achievements which you have credited to your name. So Avinash sir is the chairman of NIRC of ICAI. He's the fellow member of the Institute of Chartered Accountants of India. He did his graduation from Sri Ram College of Commerce, Delhi University, and was awarded the best student of the college. He is also in the merit list of ICAI in CA final. He is also a law graduate and completed his LLM in the International Taxation from Vienna University, Austria, Europe. He has authored 3 books on international taxation and transfer pricing. Um, he has been elected to NIRC of the Institute for the period of 2019-22, and he has been partner in APT and Company LLP Chartered Accountants, having head offices at Delhi and 14 branches all over India. Delivered more than 1,500 lectures at national and international levels. He's a visiting faculty member of National Academy of Direct Taxes, Nagpur, DTRTI, Sri Ram College of Commerce, ICAI, ICSI, ICWI, and Management Institutes. Over to you, sir.
Thank you, Tanya ji. Can you hear me?
Yes, sir, we can hear you, but your video isn't visible to us.
I'm not visible. Just 1 minute.
Sure.
Am I visible now?
Yes, sir, you're visible.
So thank you, Tanya ji, for this nice introduction. And thank you, Neha Agarwal ji, Chartered Accountant, for inviting me here. I think the 3 days virtual conference, what you are doing on the topic of CA, empowering the CA practice is wonderful. And I'm just listening to the speaker who is delivering on valuation. This is really good. And I'm learning about this particular subject, though this is not my subject. My subject is income tax and international tax, but still, I believe the Optotax is doing a very good job of empowering our chartered accountants and students of chartered accountants in various technical fields. But one thing what I want to say here is for empowering the chartered accountants in the CA practice, what is the need of the hour is the specialization. Gone are the days when we need a general practitioner. Even in doctor field, if you see the medicine field, if something happened to our toes or something happened to our eyes or anything, we are not going to a general physician, we are going to a specialist. With the changing scenarios, the same thing is also applicable in our CA practice also. Now we are also the financial doctors. If any client need any or feels any problem in any particular area, he need the best, he need the specialist. So this is the time when we need to segregate ourselves from various fields and concentrate only on 1 or 2 fields and become expert of these 2 fields, which is the need of the hour. This is one which is very important for doing this. And for this, I think the topics chosen by the organizers is really very, very good, and they will be very helpful. The second thing what is required is the networking nowadays, because for growing our CA practice in a longer way, we need to network with people. If I am specialist of A, when I need somebody who is specialist of B and then C and D, if we join hands and we work transparently with each other, this is the need of the hour. What we need to do. Initially, we can do it in a same region, same location, and subsequently we can do it in the longer run with the other cities and all over India, and then later on to the all over the world. And our honorable Prime Minister have also have a dream that we should have 4 Indian MNC chartered accountant firms, which is not possible without this networking. So this is the need of the hour. So there are 2 key mantra for growing the CA practice in the current scenarios, that we need to concentrate on specialization and we need to do networking and merger and become larger firms. So these 2 things are very, very important. So with this, I feel that this is the need of the hour and we should concentrate on that. I give all the best to the organizers of this 3 days workshop. Thank you very much for inviting me here and sharing and giving me this opportunity to share my views with all of you. So thank you very much. Over to Tanya ji.
Thank you so much, sir, for your words of wisdom. And you rightly mentioned that mantra for today, in today's era which we live, is first is specialization and second is networking. Actually, networking is kind of, we can say, actual net worth, which we all have. Because if we have a good connections, we could do wonders in our organization and in our professional and personal life. Thank you so much for sparing time for us and with your words of wisdom. So with the help of council members and other regional council members, Optotax will keep on doing and empowering the CA professionals and other tax professionals, and will keep on bringing such knowledgeable sessions each weekend or on as much frequency as we can. And also one announcement which I forgot to mention earlier was that we will be, because all the participants have taken their time out, valuable time out to attend these 3-day live series, we will be giving a small token of appreciation for your invaluable efforts and skills for upgrading your knowledge and skills. But to those 3 chartered accountants or tax professionals who will attend the complete course in entirely. So just keep learning and keep growing. Over to Anand sir for his deliberation. Now you can continue, sir. Thank you so much, Avinash sir.
Thank you. Thank you.
Thank you. You can see the slide.
Yes, sir.
Okay.
Visible.
So I was given a practical example of real estate asset, something like in Bombay. Even if 2 buildings are beside each other, we have to, why there is a price difference basically. Some unit is selling at say 50,000 rupees square feet, same locality building beside that is selling at 40,000. There has to be some, features of the flat, facilities, clubhouse. So we exactly in same manner, we have to identify the comparables. Don't use just numbers for comparison. No, you can't even use comparison of Ola with Uber. Even Zoom with Microsoft. You can't. Apple with Google. No, there are different verticals. You have to identify each vertical separately and then carry out the analysis. This is called as a comparable analysis. Now this is Dcf valuation. So everybody is very, experienced into Dcf. So just ignore the first half side. This is just an illustration. There may be certain calculation errors. But now what I'm trying to say is Dcf is unavoidable method, because finally cash is king. Whether this business idea is worth investing or not, that is ultimate goal of every investment or every promoter. So Dcf is unavoidable, compulsory in my opinion, but it is not only method. You have to justify Dcf only when you can get certain to very good level, but startups very difficult. So Dcf unavoidable, but apply some other, give some tadka also of other methods and justify that valuation. But in this case, if you look at here, the normal equity valuation is coming at some 1879 lakhs, but there is some risk-based adjustments. Now this is very important. 55% risk-based adjustments. So what is this 55% risk? I will explain you in next slide. So we saw that Burke's method risk or some other risk-based valuation methodology. So this is some other method which I personally have developed. I think you might find this to some other websites also, but this is something I have created for my own analysis. I will explain you this very simple method, quick. I have identified 12 different risks typically a startup carries. So I have given all these risks mentioned here. There may be certain more risks with every other company, but typically these are the different risks normally every startup is carrying. So give them marks very low. So it's a good point. Low, extremely low, high, or very high. And give marks according to this each point. If there is not applicable, say I'm only into India, then give 0. India is not Afghanistan to give -2. India is 0, no problem. India is also not 1 or 2. 0, neutral. And then I have identified, given this financial model, fine, very good. So far you are at a very early stage, but you will earn 50 crore profit after tax in 5 years, no problem. Which I evaluated excellent, but your stage does not permit me to evaluate you to at that level. So I did this analysis. I calculated that I need to incorporate so many risk-based adjustments into your own valuation, 55% valuation risk adjustment. So I reduce 55% here. Sometimes even we reduce 80%. Because promoter insists us to use their own business model. I said, fine, I don't apply my thought, but I have my other tool to decrease your valuation. So I give stage of business -2, 2, 2, 2, 2, and then reduce everything. So this is my own. I'll be sharing this my slides and everything with you soon. So don't worry about this. And this is very simple. This is not again final. Everyone has a right to increase or decrease it. Every company will have different. For example, this non-veg delivery chain will have supply chain risk, very important. IT company, not that much, country risk, again, India is okay. Exit value, very important risk. Exit value means whether I will have buyer or not, basically, or I'll be as an investor or as a promoter, whether I'll be exit or not. So these are different risks. This is my own table. You guys can use it or you can modify it suitably. Then this is traction stage startup. So earlier already, you are into pre-series A or already got some A series funding. You are getting a traction now. This is the ideal actual case with us. So they have given us projections in this manner, rupees in lakhs, 4 crore first year, and after 5 years, he will be like 400 crore. And this is the management EBITDA projected 200 crore out of 300 crore. We have to accept that projection, no doubt. But we as a valuer, as per valuation standard, has the right to restate valuation model with proper justifications. Now, restate is subjective. In my opinion, it is not subjective. You have to calculate that restatement model and give your logics. So we evaluated these projections, revenue projections, at these numbers. You look at the difference, 85% discounting to the revenue projected, 60, 50. Logics was there. I identified similar AI company into similar segment. We see none of the companies identical. You have to identify similar. So I identified those companies. I saw their growth rate, growth pattern. I saw their EBITDA pattern. So again here, database will come into picture. You don't need to buy a very huge costly database. You can just go and buy. There are multiple like Zoba Corp. Even those database they will charge you 300, 500 rupees, but they will give you an entire list of valuation, multiples, and all this stuff in a very structured manner. You can see all the financial analysis in a very simple Excel sheet. So growth rate in line other segments, present orders in hand. So this is how we establish the revenue model for them. And promoter had no answer for this. He was mum. Once I presented him all the numbers. We use NASDAQ AI listed company database. This is free actually, something like BSc, NAC. You will get everything on NASDAQ. ROC database. Methods we applied DCF only, beta calculated, since AI listed companies are not much in India, in fact none. So we used NASDAQ basically to beta calculation, and even the terminal value was also using exit multiples of listed entities with certain adjustments. Like TCS exit multiple, like P will be 35 for example as now, but I can't use TCS multiple for any other smaller company. So I had to do certain adjustments depending on the profitability percentage, cash reserves, growth rate of the revenue and all that part. Then again, comparative study of other deals, to check sanity. This sanity check is very important. Unless you do sanity check is nothing but common sense. Apply. You can't just give something, this diamond is 10,000 rupees and this diamond is 10 crore. You have to give some logics behind 10,000 and 10 crore. Identically, you have to give logic. So unless cash is there, it has no value of your intangible asset. Now, in terms of startup, I hardly found any intangible. Everybody call I'm a technology startup. I said, where is your technology? So basically, it is just a concept, and they have created some, software spending some 20, 30, 50 lakhs rupees, and this can be replicated. Anybody, even I have developed certain softwares, hiring some, college graduates, and I have developed. So I can also do that. May not be that kind of level, but someday I can do that. So that is not, software is not technology. Technology means it has to be certain, acceptable to the common man. It should have, again, most important, baniya ka rule, cash kidhar hai, ya kab aane wala hai. No cash, no value in this world. Even if you see Zomato, everybody is burning money there because they know someday I'm going to earn the cash. So without cash, no value. One night you will crash without cash. Different, this example of WeWork only 50 billion to 6 billion in 1 month. No one has an answer. So when we see there are multiple intangibles and all, please apply your thoughts. Whether what is intangible asset? Everybody says these are the good brand, good customers. There are methods or logics to apply to the customers. What is the longevity? Whether non-cancelable agreements, rate contracts, what is the stage? So it depends. I mean, now examples of intangible assets like marketing related, like trademarks, brand names, customer related like agreements mostly, artistics like films, music, rights, contract related, and technology related. Like patented technology, database, having own patent or having license to use patent is also intangible asset. Okay, so identify those assets also while you're doing the intangible assets valuation and overall valuation of the entity. Again, I have given here, like, although similar intangible assets within same class will share same characteristics with one another, they will also have differentiating characteristics. Take example of Zoom. I use Zoom. I also use Microsoft Teams. Can we compare them together, Zoom and Teams? Broadly, yes. Minutely, no. Broadly, yes means 50% characteristics are same, but Microsoft Teams have way better other options available. It can sync with Word, it can sync with Excel, all that things are there. But Zoom has only dedicatedly on this conference line. So when you are comparing Zoom or Teams, you have to identify those differentiating factors, characteristics basically. Again, here certain intangible assets such as brands may represent combination of multiple categories like Apple and Google. Although both are like one of the world-class companies, But in my opinion, both are different ways. Somebody is earning from data, somebody is earning more on the hardware side, and both are leading. These are typical steps in the valuations. One, understand what you want to value, scope, purpose. If you are valuing company for sale, different thought process. If you are valuing company for fundraising, different thought process. Valuing company for joint venture, different thought process. Understand that identification and understanding, understand the business model, office, manpower, process, financial structure, etc. Do your own analysis. Due diligence. I will advise how to carry out due diligence also. Due diligence. And do some calculation of draft with proper justification, ready-made database with you, and to discuss with the management. After this third test, and first very important is apply your first common sense. If it is worth, company with say 1 lakh of capital and 2 lakhs of profit worth 50 crore or not, apply your common sense. I'm not saying it not valued, but apply. If you saw some issues in that common sense, please rework and then you issue the final report. These are the steps in the valuation. Then due diligence for valuation of startups. One is financial due diligence. Very simple. Everybody should carry out this, like statement analysis, usually small set of numbers. Capital structure analysis. You will have that cap table. Understand cap table very carefully. Don't rely 100% on that. You will see convertible debenture, CCPS, ESOP pool. Understand what is ESOP policy, ESOP pool, convertibility, how much money you can generate out of ESOP pool. So don't factor everything in the DCF. Understand conversion ratio of the CCPS or CCDs, and then apply effective capital. Projections, assumptions, financial analysis, market trends, growth margin. This you need from other companies which you identify as a comparable. If some company is growing at, on an average, let us say every company is growing at say 50% growth on an average, you can give 50% or slightly more to your target company, because historically they were growing at 50%. That time market was new, but now newcomer can grow more than 50, no issue, but don't give 150. You can give 60, 70, 75, no issue, but it has to be some logic. Again, capitalization potential means whether this is a really sellable model, if they require continuous money, whether it is a sellable model with going forward also with the investors. We have to check that. Historical deals and projections, CAC, like customer acquisition cost, break-even point, and product-wise or vertical-wise EBITDA. You have to identify this very carefully. This is broad steps of due diligence coverage in financial areas. Operational areas, again, product market potential, recent deals, active market or not. If it is inactive market, recently I valued one home optimization company for, I don't remember, revenue of I think 2 or 3 crore, and I think I valued at 20 or 15 crore, something like that. But they have very fantastic product line developed, invested huge money, almost 3 crores into that, and very kind of advanced level products. I think same technology Samsung phones are also using. So that kind of technology they were using. So I analyzed that, and already 2 crore sales is happening. Now they need some capital, 2, 3, 5 crore to go to market condition. But on analysis, what I found, this is not an active market at all. Out of my database, I could find only 3 or 4 deals in last 5 years. So if there is no active market, then what is the value of investing into that? I could give 50 crore valuation also to that market, because products, excellent products. Efforts I could see, everything was ready. He actually showed me demo of those products. But what is the use if there are no active deals? Where are the investors? So only strategic investors will come in. So number is limited now. So you have to reach to a level first, and then strategic guys will come, or now also they can come, but valuation you may or you may not get. So deals information, finally data is your god in valuation. Peer comparison, management quality, growth rate, and future potential. These are operational part. Third, participant perspective, most important. Valuation is one-sided. Every valuation is biased, but biased not illogically, biased legally towards participant. Participant means person for whom you are going to do the valuation. For example, if you are appointed by a promoter to carry out the valuation, yes, you have to understand his thought process and then apply that market conditions, financial modeling and all. Same thought process is not applicable for same company when you are doing valuation from investor perspective, because investor has a different expectation. So he will give you his inputs. Now, if you are like a equity research analyst for listed entities, that time participant is who? Investors. So they are not large investors, they are also not promoters. So you have to apply your own thoughts and carry out the valuations. So participant perspective, this is not mine, this is written in the standard. That is why I use the word legally allowed. Standard has specifically written this. It's a valuation perspective, participant perspective. That is what every valuer has to apply. That is why there will be always disputes when with the valuer on the land and property when we are going to raise the loan. So when I understood this logic, then I stopped arguing with them, because they are valuing not from the borrower's perspective, they are valuing from the lender's perspective. That is why there are differences. Then look at the fair demo of the product, what is actually happening or not. I usually when there is a e-commerce platform of say clothing or food or something like that, I, as a part of my process, I actually order some of the services from them. I see efficiency, whether it is not there or there. Recently there was one deal into e-plants. So they were actually delivering plants across India, very unique plants, slightly costly than anything available on the live plants available on Amazon anywhere. I actually delivered, and they actually delivered me in 3 or 4 days. Same fresh plant. I don't know how they are able to preserve that plant into that packaging, but plant was so fresh. I was so happy. A very unique plant. They sold it me for like 700, 800 that plant. I could get that in nearby store. I could not get actually, because that was a very unique plant. So I actually ordered that kind of services from them. There was some company into some diet management. So I actually ordered some products. I actually read, I actually applied, thought to that, whether it is correct or not. Then term sheets, you understand term sheets, restrictive clauses, very important, restrictive clauses and certain rights to the investors. If you are investing, you see there are, discounts and premium to the valuations. So when there are restrictive clauses that promoter can't do this, that, or whether investor will get the board seat, investor will have so many rights. So every deal has certain special characters in the term sheet. Read it carefully, and you have to identify some premium amount for those special rights to the investors, because I am having 5% stake, and my other friend also having 5% stake, but that friend is having one board seat right, and I don't have. He will get better valuation than me, maybe 5% more, because he is on the board. And exit potential. What is exit potential? Exit potential means whether it is active market or not, whether there will be exit possible or not. Very simple. So these are the due diligence. If it is not active, so we usually give very discounting to the normal value. Although that plant I could see, okay, fine, boss, everything is good, very good potential. You can reach 50 crore, but I could not found more than 3 or 4 deals into this segment. Even promoters were shocked when I told them. And deals were also in the range of 5 crore, 10 crores. On all our startups, I do not know what will happen to that market, or what will be the size of every company after 5 years. So they were also agreeing. I mean, I said, give me other alternative to your competitors also, at least I can see. But I could not saw. So even exit potentials is very important. अगर एग्जिट में पैसे ही नहीं मिलेगा तो फायदा क्या है बिजनेस करके, इन्वेस्टमेंट करके. So this was my So presentation, if I'll be sharing this presentation with you, and you can share with the participants. Or if we have time, we can have some question answers also. I'm happy to answer. Hello, Tanya ji. Okay, I think I can take some questions here. I'll go from top. How Zomato was valued? And there is no, I think it's more of a desperation valuation. There is no answer. It is basically a milestone in Indian stock market of valuation. So maybe you can use Zomato valuation for Swiggy or some other listed companies. This is my own this thing. Then terminal value of DCF. Yes, there are normally two methods to carry out terminal valuations. One is the constant growth model, and one is market linked also. Market linked means basically you can see similar companies at what price they got sold, or listed entities at what price they are going to trade, say sales multiple or PAT multiple, like that, and you can apply that also. But you have to be in a very active market for that. If it is not active market, then you simply grow on a constant growth model. Then transaction databases. Yeah, as I told, venture intelligence is one of the database we use, and VCCH. This is very famous portal called VC Circle. So they have this database portal also. So you can use that. What is that is separate. How valuation to be done for liquor retail business or private limited? Normal, I think Dcf is sufficient for that, because you can, depending on the size and location, you can fairly estimate the business and profitability. I know standard profit is 5 and 10% gross margin, but it's a very cash generating business, fast moving. A registered valuer process is very easy. Just go to institute review site, also ICAI or ICMAI review website. You will see all the process. It's very easy, not very complicated. DLOG, DLOM, it's again judgmental. DLOG is discount for lockup, control, and marketability, basically. It's judgmental, very. Like as I said, whether I'm getting board seat or not, or I'm getting majority shares or not. So you can give some premium or discount to the value. Again, marketability, exit or active market or not, all this part. So that is DLOG and DLOM. Yeah, I think most of the questions I have covered.
I guess sir have done the full justice by answering all the questions which our participants have asked. And thank you so much, sir, for the wonderful deliberation about how startups are valued and what is the due diligence for valuation at different stages. It really, really means us a lot. And also, again, sparing time despite your personal commitments. So thank you so much, sir. Really looking forward for a long-term association. And we will be hoping soon another webinar in coming times. Thank you so much, sir.
Thank you so much. Thank you, participants. I'll be sharing this session with Tanya. You can share with
Sure, sir.
Thank you so much.
So, thank you so much, sir. So now is the time when I would like to call upon our other faculty for today for make you all understand about the framework for startups in India and stages of startup and funding requirements. So we have today with us ca.rahul Saria ji. We welcome you, sir. And first of all, I would like to extend my heartiest, I am grateful for you for accepting my request and rescheduling your lecture towards 6:30, whether it were earlier it was still till 5. So we welcome you, so on our platform. And Rahul Saria is the co-founder at Nimble Growth Organics. He also had his consulting firm in finance and legal domain. He has served as head of finance CFO for various globals and Indian startups, Nia.co, Rento Mojo, Vedantu, etc., backed by marquee investors like Sequoia, Excel, Global Brain, Tiger Global, IDG, TAL, Omdia Networks, West Bridges, etc. He had helped establish the complete finance function from scratch for many corporates and startups. He has extensive experience in fundraising, debt and equity, 150 million plus, finance controllership, audit, income tax, GST, internal controls, financial planning and analysis, business finance, and treasury function. Over to you, sir. And I guess Rahul sir is the perfect person to guide you all how the startup framework is prepared and what all is startup about. Over to you, sir.
Thank you, Tanya. Can you confirm my audio is clear? Hello? Am I
Yes,
audible?
sir? Yeah, sir, you are audible.
Okay, cool. Thanks, Tanya, for inviting me. Hi, Neha. Nice to meet you. I think Mr. Anand really spoke really well, and that was very quite insightful even for me. I would be talking more on the startup front, but wearing a very different hat probably. So just let me start with sharing my screen. Yeah. The screen is visible, right?
Yes, sir, yes, sir.
Sure, thanks. Yeah. Cool. Hi, everyone. I'm Rahul. As Tanya introduced, thanks for the quick introduction on me. I think I've worn various different hats in my career since last 12 years or so, since the time I became a chartered accountant. Having said that, I have had my own practice in the traditional mode where I've worked on the audit front, taxation front, etc. Post which I changed my track towards consulting a lot of startup companies, specifically in terms of helping them raise funds and identifying the right key opportunity in terms of growth of their business. Of late, we started our own company. It's called Nimble Growth Organics, which we are into organic farming, where we produce and supply organic fruits and vegetables in and around Bangalore and Hyderabad area. Right now in southern part of India, but we are expanding very fast. So I think that makes a perfect combination where I can actually tell you the complete transition from being a traditional chartered accountant into practice to moving to a startup consultant to ultimately a co-founder in a startup, right? What I would request from all our participants, I see a lot of chartered accountants out there, right? And it's a stage for the chartered accountant. And the topic that was given to me was how do we actually enhance the chartered accountants from practice in practice, right, today. So my request to you would be today, just take with a pinch of salt where I may be deliberating on multiple topics today, but having said, you'll have to wear partly remove your chartered accountant hat in multiple times and again wear it and to just to be along with me and understand where I am trying to drive the whole discussion towards. And I can bet you at the end of the session, you will definitely enjoy our discussion and happy to take questions, whatever, right? So let me start with what is startup. So though my session was supposed to be before Mr. Anand, but yeah, there were some concerns on it from personal end. Otherwise, this would have been exact rapport between what I speak and what he is talking about. That's nevertheless, it's absolutely fine, right? So my first question to anyone would be like, what is a startup, right? How do you define startup? So generally, whenever I'm talking to a particular professional, especially chartered accountants who are known to work based on the definitions that's available in the market, right? So, or it could be some other law. General tendencies towards to go to a particular law. What defines a startup? Now, presently, I would want you to again leave that hat and just be with me. And if you ask me what's a startup, say for example, I start a small pan shop. Okay, it could be a pan shop or a grocery shop. Would you call really that to be a startup? A lot of definitions may say no, it's not a startup, or maybe a lot of opinions may say it's not a startup. Right? If you ask me personally, it is actually a startup. So startup is just a buzzword in today's world. since time immemorial, right? Whenever you used to start any particular new business, I would say it's a startup, irrespective of what it is. Right? Whatever kind of business model, whether it's a corporate model or not, we'll deliberate on that as well. Whether it's a corporate model is better or a new model is always better. Does it require to be innovative really, right? And are all the startups today, what is available in the market, are really innovative? Which is where I think very clearly answering the question on what is a startup, right? So I just found one very interesting a picture in Google, which I'll give you 30 seconds. Just go through the flow of this, and then we'll probably discuss on what does this picture actually say, and then we'll define what really a startup is. And generally, I'm a fast speaker. If you think that I'm going too fast, just feel free to unmute and just tell me that, yeah, please slow down. Because generally that's my habit of speaking very fast. Cool. I'm assuming that you guys have gone through the whole flow. Now let me just pinpoint certain of these. So again, this is not sacrosanct, right? Whatever you see in these pictures, different milestones need not be exactly what needs to be done. So, but eventually, what is more important in case of startup, right? There has to be a founder or a team of co-founders who lives in the future ahead of their time, which means, is there a problem? There is a problem in the market which you are trying to solve for the real consumers. Second, could be if there is a problem which we as a consumer not even realizing, but you create a solution, then tell the audience, boss, there is a problem. This is a solution that I've got, and start using it. So it's kind of a visionary. So what's a visionary, right? You have to think from the very futuristic perspective that what can I bring which will be the next big thing? Like, for example, electric cars or electric vehicles for that matter. Even Mr. Anand was mentioning about this could be a real game changer, right? If the companies like even Hero, Honda, or it could be other Bajaj or two-wheeler companies, they don't really innovate and bring change in terms of the future, it may fail. So I was having conversation with someone, he said, what do you think a particular car company would be valued most for? The idea could be that a car company may completely lose their complete value in the future, considering unless they don't move to electric 100%, right, in the future. That's the future, like, because we're depleting the oil resources, the petrol, diesel, and you know the cost, how it's increasing, right? They, as a founder, you need to find what is missing in the world, make a prototype product. I mean, it's like a beta version. It's a different kind of product where you just try to first level of product, which is very basic in nature, and then try to showcase it to the world and try to understand whether that product is really working or not. Finally, after making multiple reiterations from the prototype itself, then you move towards the launch of the product. Once the launch is done, then you get your first 1,000 users. Now, don't go just by numbers, and then you grow 5% week on week. Is it easy? Is it tough? It's very tough, definitely, but it's doable, right? And finally, it says you keep on growing, and after 4 years, you have 25 million users. Finally, it's called a success, right? So what's the most important thing? One, you're building something very unique, or it could be a kind of monopolistic thing. But the most important and the vital part of this whole picture is that you have to grow and scale very, very fast. So now if I have to redefine what's a startup, actually, I don't care what's a startup, right? Unless it comes to our role as a chartered accountant while we are helping other startup founders in terms of getting a lot of compliance, etc. Of course, we'll talk about that as well. But as a founder or as an investor, if you have to be really a startup, let's call it as an investable startup, not a startup per se. So what is an investable startup? Investable startup is a startup which can scale very, very fast, which can actually get a lot of traction in terms of business, in terms of revenue, in terms of users. That would be really defined as a startup. So I hope I can make the clear distinction between a startup and an investable startup. There are a lot of my friends who run very interesting or very serious businesses. Normal, we call it a lifestyle business, where they make huge revenue. So I got a company got funded, which had a top line of just 2 to 3 crores, and they raised an amount of 10 crores, right? Which is where when I was speaking to my friend, he said, hey, my company does a turnover of 30 crores. Why can't you get me at least 40 crores funding? So my question to him immediately was that the company which has got that 10 crore funding with a top line of 2 crores would be actually getting a revenue of 20 crores next year and 100 crores the year next. That's the kind of scale that we are seeing there, 10x and then 5x at least year on year. What can you do? So today from your 40 crore top line, can you at least move to 60 crores next year and then 100 crore the year next? The answer was no, because it was like a traditional business in a one localized area with very less technological presence. So again, is technology really very important to get funded? Not really, if you can still scale at the same pace without using technology, but which I think it's very difficult. There could be certain models, but very difficult to say that I'm going to grow my startup at a super high pace, very fast scalable, but without using technology. So which is where the question of technology becomes very relevant and important in terms from the investor perspective. Now, since you have defined startup, then the something that we all know very well, right? So a lot of you you may chide me saying that why are you even telling us what are the forms of organization available? But from the startup perspective, there are three important, very critical. So when a startup client comes to you, right, he may ask you. So just think from their perspective, stepping into their shoes, they may not even be aware what are the different forms of organization. Now it could be a proprietorship, a partnership, a company, a trust, society, non-profit, etc. Right? We all are champions of law and the taxation front, that okay, what is the best form of organization to start with? But what I am trying to drive here is that when you're talking to a particular client or a prospective client, you need to first and foremost start with the term that is business. What is the business model that a particular startup is planning to work on, and how are they planning to scale up? So it's always important to understand the perspective of a founder, getting into his or her shoes and understanding what is their vision like, right? Understanding what kind of business they are into, whether it's a B2C model, whether it's a B2B model. I will discuss all these terminologies, or there are a lot of terms in the startup world which needs to be taken and understood by professionals to actually step into their shoes, right? And then the first and foremost has to be business. Say, for example, a new guy comes to you and says, I want to start my startup, right? Now there would be multiple guys who would say, hey, just get me a GST registration. Then the next question is that whether you are eligible for GST registration or whether it's mandatory for you to have a GST registration or not. And if someone says, I want to start a company, just start a private limited company. But you need to actually evaluate, can we start with a proprietorship concern or a partnership firm and then move to a company, right? Whether there's a real business need to start a private limited company from day one itself. So these are some where you can actually say, of course, you can make some extra bucks by selling them a wrong idea, but that's not the best way to move forward, where you actually help your clients choose the right, make friends with them, tell them that we are on their side, and then finally grow along with them when your clients grow, right? That's very critical and important. I'm not saying that happens, but there are certain practices going on in the market even on that front, right? But having said that, the most important question would always be what kind of business model a particular company is into, and then helping them choose the right form of, like, for example, if there are already investors who are willing to invest in a certain idea, obviously investors would not be willing to put money in a proprietorship or partnership concern. It has to be a company where you issue shares to the investors. So similarly, you need to understand what kind of business model a particular company is into. Post which, again, I will not talk much on this. We all are aware, once the organization has been formed, there are a host of compliances in which startups. So a lot of CA friends in practice come and ask me, hey, what is different in terms of a startup versus any other normal, right? Let me make it very clear out here is that it's nothing different. Just as you advise your other clients in form of forming a company, getting all the registration done, startup is exactly similar. There's just one difference which we'll discuss in detail in upcoming slides. So obviously you need to take PAN, TAN, trade license depending on local laws. You need to go for a SNE, P-tax, current bank account, etc. I think a lot of these have been solved by MCA now recently already. You get a lot of these registration at the first level at the forming of company itself. But again, the compliance list is huge. It does not stop there. You have to take PF, ESI, GST, IEC. Now IEC is something that you may require, you may not, right? Say, for example, if you are into import and export of goods, IEC is mandatory. If you are into import and export of services, IEC is not mandatory. But there are a lot of government schemes like SCIS scheme, etc., which you can actually avail benefits from the government. Then you will have to take a IEC, right? I'm told that IEC is being replaced by PAN very soon, but I don't know when that would happen. FEMA RBI guidelines is something that is mostly relevant for startups. Any startup raising money from overseas need to comply with your FEMA and RBI guidelines in terms of specifically in terms of valuation, and a lot of filing needs to be done, in which this is one area that chartered accountants can actually delve into, mostly taken care by non-CAs, either it could be lawyers or company secretaries, but CAs can actually play a good role into FEMA. Like for example, when you raise equity money from outside India in terms of FDI, you can actually read the FDI law, whether it is under approval route or whether it's in a government route. I mean direct route, and then you need to file. There is a form called FCGPR, and in case there is a transfer of shares from a resident to a non-resident or vice versa, or between one non-resident to another non-resident, you need to file a form called FCTRS. So these are some of the regulations that is very, very critical. And again, valuation is something that we have already discussed in length in the last session. Then depending on the kind of business that one is into, there could be different licenses, environmental clearances, and insurance. Like for example, in my company, Nimble Growth, we need to take organic certification as per APIDA, that is the government organization, approved organization, right? It's an annual audit certification that requires at the farm level, which needs to be taken. Now, without boring you more on these laws, commercial law, etc., I'll straight away deep dive into Startup India registration. Right now, what is it? Again, this is more from a compliance perspective. This is not my area today. I have done all these things a lot in the past, but it's important that we discuss these, right? So there is a portal called startupindia.gov.in, which actually defines what's a startup, right? This is where a lot of my CF friends would say, yeah, Startup India has been defined. But having said that, again, I'm telling you, investor does not care whether you are registered under Startup India or not. Of course, it is very lot beneficial for you as a promoter or to register in this portal to get a DPIIT registration. Now, what is DPIIT? Again, it's a government organization which tells you if you can register as a startup under this Startup India program or not. There are a lot of benefits, which definitely it's suggested to get your startup registered under Startup India. And there is a professional scope in terms of business where you can actually go and tell startups who are not aware of this and help them get registration, a lot of tax holidays, tax exemptions that we will discuss now. A very simple portal, just go to this portal. There's something called startup recognition. The form filling would take maximum 25 to 30 minutes, where you need to tell whether a startup is innovative, whether it would actually generate employment, what is so only the conditions, major conditions are 3. 1, you can take DPIIT registration as a Startup India registration. Again, these are synonyms. The company should be less than 10 years old. It could be a private limited company, it could be a registered partnership firm, or it could be LLP. And the turnover of the company should be less than 100 crores in any financial year. So suppose if you have taken a startup registration under DPIIT and in any of the particular year, your turnover increases by more than 100 crores, you are out of Startup India registration. If you cross 10 years of age as a vintage in your company, obviously you are out of DPIIT registration. As simple. How much time does it take? Filling the form takes 30 minutes approximately. How many days do they give you registration? In my experience, it has come in 3 to 4 days. Sometimes it may take maximum of weeks time, but it's a very, very simple. Though when you start filling the form, it may ask you, please prove that your company is innovative, your company will generate employment. But let me tell you, practically, these are all just placeholders. You just need to write something there. And I have not come across any company who has been denied DPIIT registration at this level like this. Well, it's just a basic Startup India recognition. Any company can get this. But does this itself in itself give you all the benefits? No, this is just the start. This is the first level of registration. Then you move to something called ATIAC, which is like a tax holiday in the Income Tax Act, which is available only at 2 conditions. 1, you should be DPIIT registered. Once you are DPIIT registered, you can fill a form 1 in the same portal again. You need to apply that form. Now, what does that form require? Again, very basic, simple questions. You can fill this form in less than say 15-20 minutes if you have done already DPIIT registration. Here, the catch is only a private limited company or an LLP is eligible for this tax holiday under ATIAC, right, of the Income Tax Act. But the process is very, very stringent. Practically, how many startups have actually got this ATIAC? It's a very small number. They have not disclosed that number very openly. But what I hear, not even 1% of the company or 2% of the company who apply for get this tax holiday. Why? The question is, you have to prove your innovativeness. You need to prove that you would employ a lot of, you will generate a lot of employment in your company. Now, the question on innovativeness is something that is very, very subjective. Now, there have hundreds of, now the people who are evaluating this innovativeness, I do not know. How do you actually check the competence of those people who are trying to tell you that you're not innovative, right? Now, I start a company, say, for example, into a radio taxi, right? Like Ola, or it could be Uber. Now, you may say it's not innovative, but does it really matter? I can always say that Uber and Ola are on the tier 1 and tier 2 cities. I am starting Uber for tier 3 cities. Now, is it innovative? It is not. But is it not innovative for a tier 3 cities per se compared to tier 1 and tier 2? It is indeed. I'll give you an example. There was a company called Taxi for Sure, which started along with Ola. Later on, Ola ended up acquiring Taxi for Sure. Now, if you go by really innovativeness does not really mean that it has to be a completely new idea. In fact, let me tell you, investors love when you're trying to copy an idea. But obviously, it cannot be exactly a copy and paste. It has to be copy paste with some innovation. What kind that innovation could be? That innovation could be providing the same services or the product at a lower cost. So my cost of production or my cost of service are lower because of the improvement in the technology that I use. That could be one. Or there could be further improvisation in the services, but in a similar domain. Right? It's a better quality of service or the product that I give. Even that is like innovation. But again, justifying that in front of government officials is very, very tough. In my opinion, I do not know much companies who have actually availed this kind of tax holiday benefit. But yeah, that's something that you can always try get into. This is a one area of practice that can always be looked into. The other one, which is like angel tax, like tax exemption under 5627B. Now, angel tax is a term that is being used in the startup world. Now, let me reveal you something very, very interesting in these terms. As a professional, right? As a chartered accountant and a professional, when we talk to our startup clients, when you're talking to your startup clients, founders, promoters, right? You need to actually get down to their level and talk to them in terms of from the business perspective. So I'll tell you what is happening today. Almost 90 to 95% of CAs, when they meet a particular promoter or founder, they would straight away get into, hey, I will help you with your audits. I'll help you with your tax planning. I'll help you with your tax registration or various different compliances. This is what is the first thing most of the CAs, I won't say everyone, but most of the CAs into practice are there to pitch about their services. I think this is something any founder would want to discuss or talk about would be the last thing. I'm not trying to demean the service that we provide, but I'm trying to open the eyes of the practicing professionals where as startup founders, we don't really care how do you take care of all the compliances. We are purely interested into increasing our business, scaling up fast and ensuring that we are able to capture the market. So if you can really value add in terms of business front, you're most welcome. Otherwise, if you come and tell a startup founder, right? So of course, I am a chartered accountant, I may understand, but most of the startup founders are from the tech background. They may not really understand what you're trying to do. So if you go and tell them, hey, if you raise money from someone at a value which is more than your book value, you may end up paying taxes as under section 5627B of the Income Tax Act 1961 or under other sources. I wouldn't get that, right? Instead, I know a term which is called an angel tax. So you need to learn, as we all need to learn as chartered accountants into practices or into consulting, that there's a term called angel tax, which is being used and every startup founder understands that term angel tax. And the whole way of pitching in front of a particular founder should be, there is something called angel tax, but you don't worry, I'll take care of that. That's it. This is what they want to hear. They don't want to hear how are you doing it. You need to ensure that you need to step into their shoes and tell them there is a challenge on the taxation front called as angel tax, which you must have read about on Google or newspapers. But don't worry, that we will ensure. We'll get you the exemption from the department. That is our job, how we do it. And definitely you charge for it. That's the scope that you need to create for yourself. I'll talk a lot more on how do you talk to startup founders. What is the difference between a new age startup founder versus a old age promoter of a particular business. Now coming back to this angel tax, if you have paid up capital and share premium, including the current issue that you are doing, is less than 25 crores, you can apply for an exemption for under angel tax. Again, from this portal, there's a very simple form called Form 2. Filling up this form would take less than 2 minutes. They just want declaration that needs to upload in the portal itself, and you get this exemption within 2 to 3 days. That's have been my experience in almost 8 to 10 companies. It's a very user friendly. Interesting part is that unless there's already a scrutiny going on, or you've already received a notice from CIT at a CIT appeal level or at that level, at a scrutiny level, you can apply for this angel tax exemption at any time of the life of that startup. Of course, you have to be less than 10 years as that's a general father law, right? Which is where, say for example, if your company has been formed in 2016 and today you apply for angel tax and you get this angel tax exemption, that covers from the very inception of 2016 itself. So any notice that comes post that, you are free. There wouldn't be any angel tax case against the company. So it's very, very interesting, which a lot of founders are not aware of. So you can actually go and help them with these services. Apart from these, again, in the portal, after taking, there's a lot of other benefits like trademark application, you get a 50% discount on the fees. If it's a privately made company, generally the applying for one trademark under one class is costing 9,000. In this case, if you're a startup, you have a DPIIT number, the fees comes down to 4,500. So you get a 50% discount. Patent application fees, you get 80% discount, up to 80%. But having said that, the government fees is very small in case of patent application, but the lawyer fees is very, very high. Yeah, obviously a lawyer would not give you a lot of discount just because you're a startup India registered company, right? Winding off of the company under IBC 2016 is less than within 90 days, which is like a wonderful thing. Earlier, you know, when we try to close a company, it takes more than 1 to 2 years to just close down a company. There are multiple labor laws today, though it's being replaced by the new labor code. But even today, I think there are more than 20 labor laws. You get a self-certification up to 3 years for multiple labels. I think almost 9 to 10 labor laws has been covered. You just need to self-certify for 3 years and there wouldn't be any question asked for any Startup India. So Startup India registered company. So with this, I just wanted to quickly cover the Startup India framework, that the topic that was given to me. But moving forward, this is something very, very interesting and most important in my view, right? Which I'm more interested in talking and deliberating upon. In the startup world, as I mentioned, that angel tax was the first word that I spoke about, right? There are multiple jargons which is floating around the startup world, right? Startup world is a very different world altogether. I'm sure a lot of you must be already catering your services to multiple startups. So you may be aware about some of them. A lot of you may be aware of all of them, but a lot of you may not be aware of any of them, right? So this is the right platform to actually understand these jargons, because when you talk to a startup founder, you need to, again, I'm repeating, you need to talk to them in their language, right? Make them feel that you are part of them. You make them feel that you're part of them and you understand exactly how they're thinking and helping them grow their business. So let me start with something, the initial terms, right? What's the difference between B2C and B2B? Typically, when I ask a group of chartered accountants, they would say, yeah, if you're GST registered, you are B2B. If not, you're B2C. Now you need to again remove that hat completely. In the startup world, no one cares whether you are GST registered or not. Of course, they care from their compliance perspective, but that's the CA or the internal CFO or the finance team or the finance controller's job to ensure and take care of that, not the founder's job, right? From the founder and the investor perspective, the business model is very, very important to be defined, whether it's a B2C model or it's a B2B model. So when I cater to my clients as an ultimate consumer, it's called a business to consumer business, right? B2C model. When I actually give my services products to a business who would further use that for their ultimate customers, that's a B2B. Say for example, in my company Nimble Growth, we supply fruits and vegetables, organic fruits and vegetables, to multiple B2C aggregators like Big Basket. It could be other online players. It could be large format retail store. It could be independent store who further supply that to consumers. So we are a B2B company. We are not a B2C company. Now there are different models, like it could be a which are improvisation in the terms like B2B2C model, where I supply my fruits and vegetables through a platform which is selling. Say for example, tomorrow I do a partnership with Big Basket. Say for example, I'll give an real life example. There's a company called ID, which produces idli, dosa, and batter in a very nice packet form, very good quality, right? Which is partnered with Big Basket. It says that, so Big Basket, when they supply their products, it says ID batter, a quality product being delivered by Big Basket. So that's kind of, I could say it's a B2B2C product business model. Similarly, a B2C product could be, okay, yeah, let me give you one example to just explain that GST thing, right? So suppose I am selling furniture as my startup, right? I can sell that furniture to directly a consumer through Amazon. That's a B2C model for me, right? Or
from my portal directly, right? Or from my portal, I sell the furniture to a particular company. Now that company has bought that furniture for their office furnishing. Now for that office furnishing, as per GST, obviously they are GST registered. They would take that GST input. So as per GST, it's a B2B transaction. But in my business model, the company is actually the consumer of that furniture. They're going to use that as their office furniture. So that's a B2C model from the investor perspective or from my startup perspective. The next interesting, which even Mr. Anand touched upon, that what's a cap table. I'll just come to that cap table in some time, which is very important for everyone of us to know what's a cap table. Cash burn, that's a very interesting term again. What is cash burn in the startup world? So in our finance language, cash burn is nothing. So if I have to define, it's my cash collected from my revenue minus my spends, that is cash outflow. So my net cash that I receive or I pay on a monthly, typically cash burn is told in terms of on a monthly basis. So what's my monthly cash burn, right? That's how the generally investors would ask or a promoter would ask. And I'm trying to understand what's the cash burn. So, but generally what it means is what my cash inflow minus cash outflow. In a startup, you have seen that generally there are losses, a lot of funds come and they burn a lot of money. That's why it's called cash burn. You're burning cash actually, right? You're burning a lot of cash. That is why it's called cash burn. In our language, so of course you can say a promoter, hey, you have a negative cash flow. Instead, if you start using the term called cash burn, they would understand, yeah, you understand their language more clearly. So there's nothing that I'm going to tell you something very new, but I'm just trying to change the perspective where you actually serve the wine in a new bottle, right? To the same consumers. It's very important. The second term is called runway. Now, what's the runway? Runway is basically how long can I actually survive, right? How do I compute that? I know, say for example, my monthly cash burn is 10 lakhs per month. Okay, I'll take a small number, 10 lakhs per month. And what is next question would be, what is the cash in my bank? How much funds I have raised? Suppose I say I have 1 crore cash in the bank. So very intuitively, you can say that obviously, since I have 1 crore in my bank, on an average, I'm burning 10 lakhs per month. So my runway is 10 months. I can survive for next 10 months, that is 10 lakh every month, and my cash would be empty. So which means why this is important? A typical investor would ask, what is your runway, to understand with this money that you're raising, how much time you can survive without raising the next round of money. Because it's in a typical business, it's important that you know what is your survival strategy. Because we hear a lot of success stories of the startups, but the fact of the matter is 95 of the startups actually die very fast, which is not being told in the newspapers on the portal. Only the success stories are being celebrated, but there are a lot of sad stories as well, which is not out in the market. But that's the truth and the fact, and which is more, in fact, 90 to 95%, right? So hence this cash burn and runway is very, very important. The next very interesting term is called ARR. So what's the annual run rate? Startup world, in the investors community, we use the term for ARR, which typically means, suppose my last month's sale or my revenue or my top line was 1 crore. I would say my ARR is I am running at a ARR of 12 crores. Simply, I take my last month's revenue and multiply by 12. The logic being, if I'm able to continue my last month's business for the next 12 months, that's a 12 months time, I would be doing an annual business of 12x of my monthly run. So in typical language, in our ecosystem, we use the term called ARR. So what's the ARR, right? So instead of telling last month I did a business of X lakhs or X crores, we typically say, okay, my annual run rate is so and so. And typically the startups are valued. I talk on valuation as well, which is very different from what Mr. Anand deliberated on, right? So I have a very different perspective, which is a more of practical perspective, not really from a legal perspective, which is on the valuation side. Typically, your startups are valued based on some multiple of your revenue. But what's that revenue? That's not real revenue. That's the ARR basis that we typically say. For example, if my current monthly top line is 1 crore, I would say my ARR is 12 crores, and I would want to value my company at 60 crores. That is 5x of my annual run rate. What's a cohort? Cohort, again, it's a very interesting term in terms of financial modeling, in terms of reading a data, particular data. I'll give you just a very small example. Say I am reading last 3 months data of a startup. April, May, and June. Okay. April, I had say X number of customers which to whom I sold. May, suppose it was say April was 100. I'll just give you some numbers. April was 100, May was say 120, and June was say 140. So on an average, if I ask you last 3 months, what was the growth, right? You would say it was a 40% growth in my number of customers that I added in my portal. But does an investor only look from that angle? No. In fact, there's a huge scope for CAs to actually start advising to startups in terms of reading their data, or not a big data, right? But understanding their data deep, understanding how do they read about it. Say, for example, I say that my April to June, the growth was say 120, say 20%, right? From 100 to 120. And from my May to April to May, sorry, and May to June, it further grew by 20, so around approximately 16% growth, right? So overall, you may say it's a 40% growth, but month on month growth has gone down actually. So from May to June, it went further down. Then when you do a deep dive of that data, you really understand that in case of deep dive of that data, there was some issue in the month of June in terms of the customers when I was actually helping them in terms of growth. So that level of analysis in terms of, we call it a cohort analysis, going deeper into that data and doing a deep level analysis. So again, I can talk for hours on the cohort, but considering the paucity of time, I'll just stop here in terms of cohort and just move to the next term. There's a very interesting term called CAC, customer acquisition cost. Which typically means how much money in terms of dollars or rupees that I spend in acquiring a particular customer. Say, for example, suppose I am Zomato and I say for getting one customer, I am giving a cashback or something of 50 rupees per customer for a new customer. So that means my customer acquisition cost is 50 rupees per customer. Now, of course, that 50 may not be sacrosanct because I may run multiple advertisements into multiple different platforms. I may give multiple discounts, multiple cashbacks. And that is the reason we get so much of cashbacks as consumers from different portals. Right? As a consumer, we win, right? But that's termed as customer acquisition cost, CAC. It's a very common term in terms of startups. The next is called a fully diluted cap table. Now, I'll tell you what is cap table. It's very, very important to understand. A cap table is a summarization of various different investors sitting on the company's business who owns different types of shares. It could be equity, it could be preference shares, it could be convertible notes, it could be a convertible debentures, it could be ESOPs, right? A typical cap table would actually tell you who are the real owners of the company, which may not be very apparent when you see a corporate filing per se, right? Because as my last speaker has also mentioned, that there could be certain convertible ratios. From that angle, a fully diluted cap table would actually tell you who are the real owners of the company. Say, for example, there's the equity share holders, the promoters. There could be a compulsory convertible preference shares, which actually tells you what is the conversion ratio for each and every preference share that you issue. Investors generally typically insist on getting a preference shares because there are a lot of benefits in terms of corporate law, company law in terms of preference shares, which is where a fully diluted cap table will tell you after conversion of all my shares into equity, how would my ownership structure look like? Now, suppose there could be a ESOP, there could be convertible preference. Say, suppose one CCPS has a conversion ratio of equivalent to 1:2 into equity shares. So suppose if I have 100 equity shares holders, I have 50 CCPS holders with a ratio of 1:2. That means it is converting into 200 equity shares. So in a typical, when you see based on number of shares, it could say that 100 equity shareholders and 50 is being held by investors. It may look like 66%, 33% ownership, but the reality would come out from a fully diluted cap table, which would say actually it's a 50% ownership. Because typically, in my experience, you get one share, one vote in a shareholder agreement when you agree with the investor. What's an LTV? LTV is a lifetime value of a customer. So how much money actually you're going to make from a customer till the time that customer actually is sitting in your platform. Say, for example, I am Facebook, right? Or say, I'll give you a better example. Suppose I'm Netflix. As Netflix, I have seen historically, when a customer comes on my platform, he or she on an average stays in my platform for 6 months before recharging. So some they take a Netflix for 12 months, some take on a monthly basis, some take for a few months and then they drop out. On an average, I've seen when a customer is onboarded, they actually stay in my platform for 6 months. And per month, I make a revenue of say $10 from each customer. So I would say my lifetime value of a customer is $60 because on an average, they stay in my platform for $60. Now, why this is very important? My lifetime value of a customer versus what is my customer acquisition cost of that customer. Suppose I say my customer acquisition cost of that customer is $10, while I make a revenue of $60 against that customer. So there's a very interesting ratio in the startup world, which is called LTV by CAC ratio. If my LTV by CAC ratio is positive and very high, that is considered to be a super high scalable and high profitable business. That is why I told you these terms CAC and LTV is very, very important. And you can just go to Google and type LTV and CAC ratio. You can read a lot about it and learn a lot more about it. The other term is called MVP. That's called minimum viable product. There are other synonyms to it like beta version, a prototype. It's something that a customer, that an investor insists that, are you MVP ready before going for your first round of investments? So you need to say, yeah, my beta version of the product is ready. It could be in form of technology, it comes form of the testing that you've done in the market. There's another term called product market fit. It's a reiteration process. Whether once I have launched my beta version, after testing multiple times in different markets, I come up with the best version of it, which is called a product market fit. It's a reiteration process in which I try to find out what is the best way of getting this my product in the market. Traction is a very beautiful word, very commonly used. It's nothing. It's very simple that if my business is growing, I would say I have a good traction in terms of business, in terms of top line, that is revenue. It could be traction number of users. Suppose I'm Facebook. I start a new company, I like Facebook. Initially, the idea is not to make revenue. Initially, the idea is to purely to add more and more number of users. Even that's a traction. But I don't say that, okay, I'm just growing number of registrations in my platform. I say my traffic is growing very fast. I have a huge traction. That is what the investors and the founders love to talk about. Unit economics is something very interesting, which I'll cover in the forthcoming slides quickly. Valuation. In terms of valuation in the startup world, right? There are two different very important terms. One is called a pre-money valuation. Other one is called post-money valuation. Now, what is pre-money valuation? I'll come to that. But let me first define you what's post-money valuation. Suppose my pre-money valuation is 10 crores and I'm raising 1 crore in this particular round, right? So my post-money valuation is very simple. Pre-money plus the amount you raise. That is 10 crores plus 1 crore. My post-money valuation becomes 11 crores, which is very important, significant term to understand. Term sheet is a document which actually tells you the basic level first non-binding agreement between an investor. Suppose when we are doing a investment round, our investor likes your idea, he or she will issue a term sheet to you, which will actually tell you what is the amount they are putting at what valuation and the major terms, with post which the whole due diligence process starts and finally you move towards the wiring of money to your bank account. Then there are terms called angel, PE, VC, which you all are aware of, but I would like to just quickly tell you from these terms to understand the market perspective of why these terms are there in the market and how to understand that. Initially, when you start a company, right, any startup, they raise initial capital. That's called as seed capital. It may be called as angel money. It may be called as pre-series company money, and it may be raised from angels or it may be raised from FNF, means friends and families. So when I start a new company, a new startup, I raise money in terms of now these are all synonyms, right? It could be called, as I mentioned, there's no fixed term or definition in a particular book that or a particular law that you need to use this. My initial level of capital, or it could be a bootstrap company. What is a bootstrap company? A bootstrap company is a company in which promoters don't raise external money. They just put their own money and start a business. That's a bootstrap company. So once you have reached a certain stage or scale, then you start moving to your early stage or later stage raising of money. It could be series A, B, C, etc. Now, who gives these names, right? A, B, C, D, E, F, different rounds? No one. The promoters decide and the investors decide. Generally, promoters decide. So depending on the level of market perception that I want to create based on my company's output, I would like to actually say whether it's a pre-series A company or a series A company, right? Now, what is this VC and a PE? VC theoretically is called venture capitalist. PE theoretically is called the private equity. In our practical world, we don't even care whether you are VC or PE. It's a synonym again. You can use interchangeably very commonly. But having said that, in case of a VC and a PE, generally, theoretically, VCs come at an early stage with a smaller amount of check. It could range from say 1 million to 10 million, even 20 million dollars. In case of PE, they generally want to take a controlling stake and they may put as high as say it may start from $10 million to even 100 million, 200 million, $500 million of money, right? At a very large valuation. And then after a certain good stage, it could be A, B, C, D, or whatever level they raise money, then they eye for an IPO, where like Zomato got listed recently, right? Before that, I don't know what series they raised last. It could be, I think, Series E or Series F that they raised before they hit the market for an IPO. So this is a very simple flow in terms of funding stages and different funding stages of a company. This is a typical process in terms of fundraise that we do, right? I will not deep dive into much because it will take a lot of time on this. But quickly, I'll tell you, as a chartered accountant or as a finance professional, there's a lot that can be played on these areas where you can actually help startups create a data book. Now, what's a data book? A data book is a historical presentation of the numbers that you have. Now, don't think this to be only a presentation of a profit and loss account and a balance. Of course, those are part of these data book and financial projections. But what I'm trying to say is that more from the business perspective, it's very important to understand the business at deep level, to even prepare this data book and a financial projection. Now, I'll tell you the difference. Typically, in terms of fundraise, we all have been accused of getting a bank funding, right? Where typically a bank funding you get against a collateral. So bank is more interested into collateral as a safety of their money because it's a interest income that they want to make. In case of startups, investors don't. So obviously there's no equity involved, no collateral involved. It's purely equity money against which they are very clear. They want to see the scale of the money. Eventually, they would want to make money by exiting from your company, either by selling their shares to someone else or in an IPO. They get an exit. It's called an exit clause in the SHA. In which case, they want to understand your business deep level. One, unit economics is the most important thing. Second, they want to understand your business deeper. Say, for example, in terms of traffic. What is traffic? I am, say, Facebook or I am Netflix. Or let's say, take example Facebook itself, right? I am Facebook. I would say that, see, my company gets at least 2 crore or maybe 20 million page visits every day, right? Out of which 2 crores, almost 10% of them actually go and click on a particular advertisement, right? There are multiple advertisements that keep on running on Facebook, right? How does Facebook make money? They make money through advertisements only. There's no other way, right? So 10%, right? Which clearly says out of 2 crores, again, my numbers are all hypothetical. Out of 2 crore ad clicks I get on a daily basis. Now, against that ad clicks, I have, say, 500,000 companies who are advertising on my platform. And as a combination of these two, I get, say, for example, I make $1 per click of the advertisement that I make. So against 500,000 companies, if there are, say, 10 ads being displayed for each company, that is approximately 50 lakhs into 10 into approximately 2 crore clicks multiplied by $1. This is the revenue per day that I can make. Now, hope you're getting my point. This is the way we analyze for each and every deep down level, that how do you move to that. Say, for example, I am trying to create a financial projection from a very different company where I say, say Netflix, right? I am going to acquire 100,000 users in next 1 month. Now, how do I acquire that? I'm going to run an advertisement in Facebook and other various different platforms. At so many, I would run so many ads, assuming I'll get, say, 2% of the clicks. Out of those 2% clicks, I get a 10% conversion in terms of customer who end up buying my product. So I am trying to actually project number of customers that I would get, what is the average revenue that I'm going to make from each customer. But having said that, to get so many traffic or getting so many customers, there is a advertisement cost that I pay to the Facebook. That would be based on a top level. So we call it as a sales funnel, right? In our startup world. So that sales funnel starts from the top number of leads being converted into warm leads. From warm leads, I convert to hot leads. And finally, from hot leads, I move to my conversion as a customer. So this whole process has to be captured in my data book and a financial budget, which typically, I strongly believe CAs are the most acute people to create this kind of business models or the financial projections. Post which, once you have done this work and done a lot of negotiation with the investors, then the comes the one area which I think a lot of you must be already be doing in terms of due diligence. Helping the company get the due diligence, you can again play from the investors' side as well, where you do a financial DD or a legal DD or a commercial DD for them. Right now, what is financial DD, legal DD? I would suggest you to go to Google and just read more about it to get more perspective on that. Then the final leg of a startup fund is would be once you've got the term sheet, then you do the negotiation in favor of the company as their startup advisor in terms of getting the right clauses on the agreement. So just to give you a quick glimpse of that, there are three types of agreement that we enter into in case any of startup funding. One is called SSA, that is share subscription agreement. One is called SHA, that is shareholders agreement. These are the major tools, and then these are deed of adherence as well. These basically would tell you what are the rights, that various different rights that can be negotiated. Now, mostly founders are not equipped, especially when they're raising their first round of money. Then they learn, right, practically after making a lot of mistakes. But if you as a financial advisor can actually get into understanding what are these terms and start advising them, negotiating on their behalf with the investors and getting the right terms for the promoters, they would start loving you. So let me tell you a quick anecdote from my practical life. When I was into startup consulting, right, full-time startup consulting, helping them raise money, helping them negotiating their agreements with the investors, helping them creating right kind of MIS, helping them creating the growth plan, helping them from the overall management of the company, purely from the business perspective, not really from the, I would say more from the business finance perspective rather than finance compliance perspective. When I started meeting the startup founders initially, I could see that I was not able to connect with them. How do I create that connect? So the blockchain was something very new. And our institute came up with a program called blockchain technology. It was a 5-day program. I enrolled for that blockchain technology program and did that course. Again, I'm not a techie, right? Just like all of us, I'm a chartered accountant, mostly from a finance and business background. But I did that course purposefully to understand what's this new technology all about. Basically, I wanted a selling point where I can actually sit in front of a founder who is a IIT Bombay graduate or a IIT Roorkee or IIT Kharagpur graduate who is really good in technology. But I knew that this blockchain technology is something very new, which he or she might not have learned in their days during their college times. That was 10 years back, 5 years back, right? Because this is completely new technology. Which is where I thought if I can actually learn this new tech, at least from a broad perspective, not deep tech as a coder, and when I talked to them about this, that would be, and it worked actually as a really wonderful. It was really wonderful for me, where they started seeing me not as a financial advisor, but as a business finance advisor who talks in their language. When they used to talk about an IoT device, I used to talk about blockchain technology. When they used to talk about ML and AI, I used to talk about blockchain technology, which is where it was like a lot of founders have actually told me, "Hey, Rahul, why don't you actually tell me what is blockchain? I have no idea about blockchain." And we became best of the friends. Then automatically, so they start liking you, I start liking them, and finally it's like talking done. And then they get that confidence that this is the person who talks our language and who would be able to actually solve our even financial needs. He knows how to get the valuation done, all other compliance, everything, he will take it. And the answer was always, yeah, there is a challenge, but don't worry, that is my problem, not your problem. You just focus on your business. That's the idea with which you have to go, and which is where I think today I am running my own company because of all those changes, the different pivots that I've done in my life from various perspectives. I think one last thing which is very, very important, interesting from a valuation perspective in case of a startup is you can see a small, very simple, basic P&L in front of you. It says, suppose my revenue per unit is 100, my variable cost is 50, and make a contribution margin of 50. That is a 50% margin. And then my customer acquisition cost is 60 rupees. I make a second contribution margin of 10 rupees negative. And then I have some absolute fixed cost of 80 lakhs. I'll give you just say some seconds for you to see this particular P&L and tell me, do you think it's a good business model in your view? You can put in the chat box or maybe unmute. If you are an investor, would you put money in such a business which is which is showing you this kind of P&L? Is it a good business model? Is it a bad business model? So I have one answer. Anthony says it's a good business model. Mayank says it's a bad business model. Any more questions? Okay. Risen says no, not a good business model. Again, Rajesh says yes, very good business model. Narayan says very good business model. Asutosh says bad. See, so many perspectives, right? So many different ones. Now let me give you a very different perspective, a different thought process, right? Good cost, 40 margin is still there. Too little info to decide if it's good or not. Okay. So some say that the information is not complete, right? So let me put it into perspective. So I know my fixed cost is approximately 18 lakhs. So let me ask you a different question then. Whoever answered or those who want to participate now. At how many units do I sell to break even this business? When will I break even this business? You can put the number in the chat box. 100,000 units. So Vinay says if I sell 1 lakh units, I will break even. And there are multiple other numbers are coming up, right? How do I break even this business? Okay, cool. Now let me come to you, right? Let me just, every unit that I'm selling, I make a profit of 50 rupees from that. But for selling that unit, I have a marketing cost of 60 rupees. That is every unit that I sell, I lose 10 rupees. So whatever number of units that I sell, I multiply by -10, it will always be a loss. So I cannot ever recover this particular money ever in this business. Apparently, this business is a super bad model. But again, as a lot of you mentioned that there's not enough data, let me just give you some more perspective onto it. Right? What is unit economics all about? Why are we looking at simple plain P&L from a different perspective? Why? What's the catch behind this? Now, assuming this customer acquisition cost is just a one-time cost. I give you an example of Netflix. Assuming for getting one particular customer in the Netflix platform, I spend $60 or rupees, whatever, right? And that customer stays for 1 month. He pays $100. But on an average, he stays for 2 months in my platform. Immediately, my revenue from that particular customer becomes 200, 100 into 2. And my margin from that customer becomes 100. But my cost was one time. My customer acquisition cost was one time. So my 100 minus 60, I make a margin of 40 rupees from one customer. The business model, which looked very bad just few minutes back, has completely changed drastically. And I'm making 40 rupees from per customer on an average. This is what I was explaining you earlier. My LTV in this case, from the customer's perspective, at a revenue level, becomes 200. LTV at a contribution margin one level becomes 100 rupees. So what I'm saying, LTV by CAC ratio becomes 200 by 60. It's a positive. So obviously, or at a contribution margin level, it's 100 by 60, which is a super good business model. What these investors really look in a business model before investing is, are you positive at a unit economics level? Then they don't care about your fixed costs. They don't care about your corporate costs, which is where we see a huge cashbacks, a huge loss-making company, but still investors are pouring more and more money. The whole idea is at a unit level, till the time you are making money, the rest, all the money is towards market creation. Rest, all the money is towards ensuring you're building your team, building your technology, which eventually would be easily taken care of when your volume grows. You need to just ensure that your volume grows and unit economics level, you're positive. That is the main catch for each and every investor that they're looking for before investing. So any business, if you can represent in such a form where you show your unit economics to be super positive, then they really don't care what is the fixed cost. They're ready to fund this fixed cost. Let me give you one more perspective. We all have studied economics since our childhood, right? And we have been told there are 4 factors of production. That is land, labor, capital, and entrepreneur. Today, if you talk to any class 11th or 12th student, if you tell them and teach this, they would say, what are you teaching me? In a new age of startup world, where is land? There is no land. Everything is rented, everything is on lease. In fact, investors insist on a asset light model. They don't invest in asset heavy capex model. Generally, they don't. Very rare, less than 2%, I would say. 98% would like to invest in asset light model. Like for example, Uber. No, none. They don't own taxis. They just have built a technology platform where they're connecting the taxi drivers along with the consumers. Where is labor? Earlier, what work could be done by 10,000 people? Use of technology has brought down to 50 people. You don't need a huge large team. Most of the startups work in a very small workforce. Infosys or large manufacturing company may have 200,000 employees. Startups would generally, at a max peak, they would have maximum 10,000 employees. Or mostly, typically, in my view, most of the startups have say between 50 to 500 employees, at depending on different level of scale that they are into. Now, what we are left with? Capital and entrepreneur. So entrepreneur is someone who has their idea, and capital is being given by the investors. This is the new age economy. We have to gear up to move towards this and understand how it works, right? This is very, very important. There was something on this part which I'll just skip on the ratio part. This is again typical corporate structure, which I think not relevant for us today. These are various opportunities for, as a professional, for all of us to actually start delving deeper into with the startups, like ESOP structuring. You can actually help them structure ESOPs. Like a startup founder does not know how much value of ESOPs should I give to an employee. What should be the terms? Should it be time based? Should it be value based or the output based? Treasury management is something that you can help them. Startup India registration benefits we discussed in detail. Investor board management, creating MIS business finance. That's exactly unit economics that I spoke about. Traffic I spoke about. Increasing the business I spoke about. Round structuring, capital management, the cap table management that I spoke about. What kind of instruments should I actually issue to the investors? Negotiation with the investors, exits, and tax planning. These are some things. I think before we conclude, I've written a very lean book on startup finance with my decade of experience in the startup world, which if you get a chance, do grab a copy and read it. This will give you a lot more deeper insights into what we discussed at a 30,000 feet level. Lucky to have a forward by Mr. Nilesh Vikamse, who's the past president of ICAI. Last but not the least, I would like to just speak on the valuation front, right? In which we had a detailed session. I think one major difference between the real world startup valuation versus what we learned in our last session is a very, very big difference, right? I'll tell you how, especially in the startup world. I'm not talking about a large listed company. So whatever Mr. Anand spoke about on the valuation front, right? That is more relevant for a grown-up startup, or which is at almost like a listed company or near to listing entity. In the startup world, the whole valuation work in a very different manner. I'll tell you how. Say, for example, I am Facebook. Let's for some time, let me assume I am Mark Zuckerberg. I am not, but let me take that privilege. Okay. Let's assume I'm Mark Zuckerberg. I'm starting a platform called Facebook. No one knows Facebook. A lot of us might be from the Orkut world as well, right? At that age. So from Orkut, we move to Facebook. I'm starting Facebook. I go to my first investor, right? Hey, I've created a platform. I want to raise money. So let's have the negotiation. I tell them I have 10 million users on my platform. And I think in the future, my LTV per user would be $1. So I want to value my company at $10 million. As simple, 10 million users in my platform. I'll make $1 per user. That's the LTV as my customer for my customers. So that gives me a valuation of 10 million. This is what my expectation is. I want to raise 1 million at this valuation of $10 million. And that means I'm diluting 10% from my company. This is my start. The investor says, oh yeah, that's great. 10 million is a really good number in your platform. I'm really excited about it. But having said that, I am not okay with your assumptions, right? When you say 10 million, very good. I agree 10 million is fine. But I doubt that you would be able to make $1 from each of your customers. That's the LTV. I'm questioning your assumption on the LTV itself. Finally, we actually negotiate, we deliberate, we do a multiple round of negotiation. Finally, we come to a conclusion. Okay, let's assume it to be a 50 cents per customer for at the current level of discussion. We both agree to 50 cents. We sign a term sheet. Term sheet would say company's valuation 1 million into 50 cents. Though obviously that breakup would not be there. That's more of a negotiation. $5 million I'm valuing the company. The raise is for $1 million. So that means there is a dilution of 20%. Instrument to be issued, CCPS with the rights, the investors getting one vote seat, blah, 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 multiple things. Done. Post term sheet, they start the due diligence process. In the due diligence process, what they observe, the DD team, which is like a professional's job, a big four or a non-big four, a CA firm's job, which they realize the 1 million users that Mark actually claimed, right? That was true, but that was the historical data. What they saw in last 1 month, actual active users in the platform is only half of that. That is 500,000, which the investor came back after seeing the DD report. They said, hey, you claim that you have 1 million users. That's true, but that's all historical data. How do I make money? You can't really make money from your user, which was there, say, past 1 year back. Your active users are only half a million, 500,000. So I'm not going to give you that valuation. So automatically your valuation comes down to, say, not 5 million, it comes down to 2.5 million. And we again get into renegotiation, and finally we end up raising only $500,000 at same, say, 20% dilution at a $2.5 million valuation. This is how a valuation is done. It's pure negotiation. It's pure the way as a founder, as a professional, you can sell your story, because raising money is a pure sales job. Let me tell you, you talk to 50 investors, you just need to convince one, and that is good enough for you to raise money. It's not built. The valuations are not built on Excel sheets. It's not done. Once the valuation is in freeze between the investor and the investee, then you go to a professional and get the valuation done in an Excel sheet. Now, obviously, if you have to do a ROC filing, you have to have a IBBI valuation certificate. If you have to go for an income tax valuation, you have to go to a registered valuer as per this category 1 valuation certificate. If it's a FEMA, you can go for a chartered accountant or go for a category 1, category 2 valuer as per different norms. Now, at times you end up taking 3 different valuation certificates. For the 2 is good enough because that takes care of most of the areas. But you end up going there, doing that valuation based on what has already been agreed. So it's now our job to get that number based on the paper and pen as well. That's the practical scenario. Then you need to justify, okay, whether it's DCF, whether it's a comparable method, that is how it's done. And at the time of negotiation, this is one way that I told you. Second way could be, since I'm starting Facebook, there's already Orkut, which has raised the funds at so-and-so level, X multiple of their revenue. That is the second way of corroborating the numbers that we are discussing in a negotiation. But that is how it works. I've done this kind of negotiation multiple times, raised funds for multiple companies in my limited experience that I have, and this is how it is done. Practically, the way we see valuation on paper and pen, and practically how a startup valuation is done is very, very. That is the reason precisely we heard about crazy valuations of each and every company. Byju's is today valued. Why I'm talking on those numbers, because obviously I've worked as CFO for a company called Vedantu in the past, which is very close to me. I understand EdTech in the industry very well, which is where Byju is today. I think if they're valued at, if I'm not wrong, some 15 or 20 billion dollars. I think it could be more. It's more than $10 billion. That's for sure. Unacademy, which is the second highest, most valued EdTech company, is valued at somewhere around $3 or $4 billion, and Vedantu would be somewhere around $1 billion or so. Now, just imagine. Is it so easy to value a company at $1 billion based on paper pen? No, it's not. But are these companies able to raise money at those values? Definitely yes. But it's purely based on the numbers, future, the story that you sell, and the way you conduct your business. What is the scalability that you can prove in the business? With this, I'd like to thank you for your patient hearing. Happy to take questions if any. Thank you so much. So there are certain questions I'll just try to take, or if the host can help me, if they have a summary of the questions. What I can see is that how does one arrive at a life of a customer in company entity? So again, this is based on your historical data, a lot of because depending on what you have, the kind of business that you are into, that would be the average or based on what typically. So based on my historical data, I'm going to work out. Okay, typically like Netflix, right now they are already into business since long. So in that case, I'll see on an average when a customer comes in, how many recharge they do. It's even called a repeat customer. That's a very important ratio again. So how many customers are doing a repeat recharge? How many of them are for 12 months? How many are 6 months? Based on an average historical data, we're going to work out what is the LTV of a particular customer. Because obviously that needs to be justified. CAC is likely to reduce or become nil as and when volume picks up. Not really. I wouldn't say CAC cannot become nil because CAC is something based on a per unit basis. CAC is for acquiring a new customer. You cannot say that I'm not going to grow and there will be a limited number of customers who will be there in my platform forever, right? It's always a new market that you would want to acquire. So it may reduce, possible, but it would not become nil. Like for example, when Swiggy and Zomato started, they were giving a huge discounts in terms of food. Today they charge a premium. We end up paying their food is sold at a very super high premium, more than the restaurant cost. Second, they ask for a packaging charge, delivery charge, and whatnot, a COVID charge, etc. So they are making a lot of money out of it. How to expand my knowledge based on startups practically as a CA? I think one, you can read my book. Not really trying to sell my book, but yeah, that's a fact. Second, more and more you can attend these kind of sessions. You can go to you can talk to your clients in the startup world, understand them more. And secondly, I think there are a lot of sessions happening across the country. You can join a lot of angel groups who are investing in startups. Join where the startups pitch. Like for example, there's a group called Venture Catalyst. There's a group called Our Ventures. There's a group called Mumbai Angels, Indian Angels, who help angel investors invest their money in the startup. So you can hear the startups talk about their business models, ideas, and you can learn more about them. How does one compute unit economics for aggregators like Swiggy, Ola? Similarly, as I just gave you an example, I would typically see, depending what is my per unit that I need to understand, a particular customer, what is the time that they are staying in my platform, how many orders that they are placing. Based on that orders, what is that margin that I make on a per order based on an average, right? It's called AOV, average order value. Based on that average order value, what is my margin? That's my contribution margin. And what is my customer acquisition cost for each and every particular customer. So that would actually give me the way of creating a unit economics. What do angel investors look for in startups, given that they come in early? How differently should the startup prepare for it? For angel investors, it's a very different ball game altogether. Like for my company, I've raised 3 rounds of angel investment already. Right now, as we overall in terms of money, I would have raised almost $1 million. In case of angel investors, it's at a very early stage. What angel investors would really look for is the right kind of team, right? Team is very, very important. Typically, they would not put money in someone whom they do not trust, right? Which is very, very important. They look for the right team, their experience. Need not be from IIT and IIMs. Really, I don't believe in that. I'm not from IIT. I'm not from IIM. I might have done a couple of courses from IIM. I'm a chartered accountant, definitely, right? But having said that, when you speak to a particular angel investor, you have to go through the right source, right reference. So when you're going through a right reference, of course, that speaks a lot that someone is backing you up. They're talking about it. Your business model has to be really good. You have to know your market really well. You have to be in a position to able to sell your idea very clearly. So they look for the right team, right business idea, market opportunity, scalability, and what is there for them, right? And what value you are raising money and how you can actually sell it. So that is where the early stage investing happens. Okay. Would you mentor CAs who want to be startup funding? Definitely would love to. Time is always a constraint, but would love to add value wherever I can. And again, we will have to work on the timing, but yeah, definitely I'm open to that. I already do that to a lot of folks, and CAs, non-CAs both. But yeah, would love to do that. I think there's so many chats. I'm not able to go back. If someone is able to, if I miss some question, you may re-put that in chat, or maybe you can unmute and ask that question directly. You can drop in an email to me. My email ID is Rahul rs@nimblegroup.in. That's my official ID. Personal ID is Rahul Saria ce@gmail.com. And we can connect.
Yes, Rahul sir have taken almost every possible question and I've answered to give the full justice to the questions being asked. Thank you so much, sir, for your valuable insights and knowledge and helping us to know what actually the terminology being used in startup and how one could actually go through it, what are the stages behind and what is seed funding, and it's a like vast ocean wherein you have to get bit by bit to understand each thing, and until unless one practice it, it won't suffice the purpose. Theoretical knowledge and practical is a complete different experience. So I would like to extend my heartfelt gratitude to all the participants for patience hearing and giving their valuable time to us, and also to Rahul sir for enlightening us with your insights and knowledge. Hope to see you, hope to have many more webinars in the coming days so that we could stay in touch and serve our community to the large. So thank you so much, sir. And thank you, Neha, for being there throughout the session. And if you would like to say anything.
I would just like to say I was very impressed with the content of the webinar, and kudos to the speakers who took out the time, and especially the attendees who sat there, said nothing, and heard everybody so patiently. So let's just go forward. Thank you for having me too.
It was our pleasure. So now we are ending this beautiful, insightful, knowledgeable session, and we will be seeing you tomorrow at the same time, 5 p.m. With another session for in our 3-day course series. So keep attending, and who knows, you will be the one who will be getting a surprise for your valuable time and efforts. So see you soon tomorrow at 5 p.m. And till then, happy Ganesh Chaturthi and stay safe, stay healthy, keep your health as priority and keep learning and keep growing. Thank you. Bye-bye. Have a good evening.
Thank you.